So this is what a down day feels like. We got really, really close. The market made a run at a record 7-day winning streak to start off a year. Couldn't quite make it. Fell short at the end. Little bit of near-term pullback. Some signs and evidences showing up of more of a near-term pullback. But nothing too earth-shattering. So I'm going to break down, our how to manage portfolio or trading when you're this bullish compared to, say, 4 months ago or even before that. So we can say, okay, what kind of strategies, how aggressive can I be? What does it mean to be aggressively bullish versus not aggressively? All that I'm going to break down. What's driving this price action? What are the big movers, the big shakers? Today's trade idea looks at one sector, kind of a forgotten sector, had a good holiday season, came down. The stock that we looked at for today's trade idea bounced off a new support level. We're going to look at that for potential bullish trade. So let's go ahead and get started. Today is Wednesday, January the 10th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video. You can do that right now while you're watching. Also, while you're watching, click that thumbs up icon. That lets me know that you like the video. That also lets me know that you want me to do it again, right? Do it again tomorrow. It's a one-click, easy way to give me feedback on what you think about what you saw tonight. Scroll down further and comment on anything that stands out to you from the video. Let me know what you got out of it. What did you learn? What was something that I brought up that you hadn't thought about for a while? Let me know your comments there. In the video description, you'll see there's a few links there. I've highlighted one to subscribe to my daily email newsletter for the Market Outlook, where I send out timestamped hyperlinked summaries of all the segments in the video, as well as a list of the clusters in the S&P 500 for today off the Market Forecast Indicator. Follow me on Twitter for more content in addition to this video. You see my handle on the screen at DavidSettle42. Always pinned to the top of my timeline is tonight's Market Outlook tweet. Like and retweet. We're trying to get to 100 likes on the Market Outlook tweet. Make sure you like and tweet there. You can get to it with a link down in the video description below as well. Finally, join the Market Outlook community on Facebook. There's the address at the top. I'd love to have you there. Comment, share, like. Let us know what you're thinking, what you're doing. It's a community of people who watch the video just like you. So come join us. Okay, well, let's start off looking at the S&P 500 here, and you can see still strong bullish posture, not surprising. But like I said, no more. We didn't hit the record. We tied the record yesterday. We did not create a new record today. We made a run for it off the lows of the day, but we could not close for a 7th day higher on the S&P 500 to start a year. The intermediate posture, of course, going into a 5th month of it being above, being bullish, since crossing above it at the end of August. So 1, 2, 3, 4, and then now looking for number 5. So 4+ months here. The pullback, the near-term line's pulling down, obviously out of the reversal zone now. We've had the near-term line up above 50 now for almost there. 1, 2, 3, 4, 5, 6 days. Again, the expectation when we get this far into an intermediate posture is the near-term line goes up and down more often. So it gets above and below 50 more frequently. Typical time frame is 7 to 12 days when you're starting an intermediate run, and then that starts to shrink as you get towards the end of one. So we've had 6 days. That's a pretty good intermediate run, or near-term run, considering where we're at. Of course, it was record-setting. That was a record-setting intermediate run, a near-term run. Momentum line's kind of languishing. It doesn't really tell us anything. It's when it gets extremely low like this that we worry about it, right? That was a concern. Look how we closed below all those low points. We quickly eradicated that on the first day of the new year, but that was a concern at the time. Market sentiment's up above 85. Now, I did want to point out, it's not too often that market sentiment's above, or intermediate lines above 50 for 4 months. I mean, yeah, it turned weekly bearish a couple times there, but not enough to change the posture. You can see they're just pullbacks. We've had this before, but we had to go all the way back to 2013 here, and really this period of time right in this area here was the last time we've had such extended runs on the intermediate posture. You can see here when QE3 started, and into 2012 into 2013. So an indefinite amount of bond purchases. You know, we had 1, 2, 3, 4 plus months. We ran out of gas in that 5th month, about 4.5 months in. Intermediate, divergence on this intermediate highs, and we pulled down the extreme low on the momentum line. You notice it wasn't earth shattering though, and then we had another one here in 2012. You know, again, kind of after an announcement, or Operation Twist was well underplay, coming off of that low point. 2012, you had a run of 1, 2, 3, 4 months before finally crossing below. So a little bit, 4+ months. There's some volatility in there. Nothing too major until the end. You can see a lot of near-term volatility at the end. And then again at the beginning of 2012, again coming off Operation Twist, getting above 50 after that low point there. And then you have 1, 2, 3, 4 months practically. All of these periods of time where we had extended intermediate runs came when the market sentiment was coming up from below 50. That's what makes this one a little unique. This intermediate run, extended intermediate run, even compared to like earlier this past year. If you look at this one, because we had a 4-month run here, 1, 2, 3, 4 plus month run, with that 4th month in February. Again, market sentiment came from below 50 at that point of time. This one started with the market sentiment line not even really getting below 60. It got a smidgen below 60. It got to 60, just a smidgen below 70 is all it got down to. So that's what makes this one more, different than all these others, is that we were already taking a pretty deep inhale to get to this point, and now we've made this big, long, extended run. You can see where all the lines of, Fibonacci lines of support will be drawn based on the intermediate run that we're on, the market sentiment run that we're on, as well as the current near-term run. You can see the current near-term run, if we were to reverse all of it, which, again, we haven't reversed all of a near-term run for a long time. So if we were to reverse all of that, that would just be a 23% retracement of this intermediate run. That's how big this move is. And if we were to come down even to 50%, which would be a 150-point drop, that would just be a 23% drop of this current market sentiment run. So, I mean, any kind of pullback, big grain of salt. Don't get wrapped into any kind of drop as to, oh no, here it goes. Now we're starting. Now we're getting the sell-off. Remember, we never sell off. And hopefully you watched last night's video where I showed you the market crash in 87, 2008 crash. None of those occurred from all-time highs. There was plenty of warning. And we'll get, there will be a trend change. There'll be a posture change. We'll break support. There'll be plenty of warning before we fall off a cliff or crash through a window, whatever analogy you want to use there. Take a quick look at the Dow Jones Industrial Average. You can see it looks very similar. Near-term lines pulling back, still in the upper half of the chart though. So we're just getting a nice little orderly near-term pullback on all of these. NASDAQ Composite avoided having its own record of 7 days in a row to start a year. And then the Russell 2000 right at that high. I mean, we're not really able to clear that high point. We're kind of trading above and below it a little bit, coming off of a cluster and a hanging man candlestick pattern. We get below that low point, which also, 1550 looks like some resistance. That's our new kind of a near-term support for the Russell. We hold that, great. We break that, then now we're probably going to get a bearish intermediate posture for a while. So you can see again why we run out of gas. It's not like we can't go up, and right now, market can go up just about every day, it seems like. But, we're so far. You just have to keep in mind how far away. This should dictate like how bullish you are. You have to be bullish. The trends are bullish. In this chart, both lines are rising, and price is above both of them. So you have to be bullish. But this should dictate how aggressively bullish you are. You can be. There's different levels, right? And I've talked about that in different videos before. You can follow the trend, but you don't have to follow the trend the same way here as you do here. You don't have to follow the trend the same way here that you do over here, coming off the 200-day moving average. You don't have to follow it the same way here that you do here when you're coming up off a long lower shadow from below the 200-day moving average and the 50. So there's different layers of bullishness, and you know, here you're not so aggressive either because you're still in a bearish trend, but there's bullish opportunity. Here you're not so aggressive because you're on a strong bearish trend. You're way up above. You're not anywhere close to a 50 or the 200-day moving average. And so again, that doesn't necessarily limit you from making bullish trades, but it limits your return expectations on those bullish trades. You take a look at the 3 green arrow chart. Obviously the momentum is declining. The MACD is about as high as it's been on an absolute basis. On a relative basis, we're kind of getting there too. The stochastic's coming down. They're both still above their moving averages. We're still well above the 8-day moving average. And to kind of give you an idea of how long it's been, again, I've shown you this chart, a similar chart to this before. I'll give you an idea of how long it's been since we have closed below the 17-day. So we've closed below 8-day just to, you know, right on the last day of the year. We closed below the 8-day moving average. But I'm going to change this MACD to look at how long we've been above the 17-day moving average, which the last time we got above is, so this MACD down here, when it crosses below 0, that means the price closed below 17. When it gets back above, it comes back up. And you can see that was one time right there that we closed below 17-day moving average. That's the only day since November that we've done that. So we've had one close below a really short-term exponential moving average. So again, it shows just how bullish we are. If you look through here, you can see, you know, that's not normal. And you can look, you know, go back a couple of years to look at the beginning of this run here that we had at the beginning of the year. So the other time we had a strong intermediate run, it was a similar pattern. You know, we had one day kind of in the middle where we crossed below the 17-day moving average. All the rest of the time we were up above it until that intermediate run ran out of gas. So in similar time frame that we're getting right now, similar setup that we're getting right now, one day in the course of what, you know, 4+ months now. That's an extended period of time. Again, doesn't tell you not to make bullish trades, tells you not to expect big returns from today going forward on any new bullish trades. Obviously, the ones that you currently have should be giving you some really darn good, decent bullish returns. You don't see this too often recently, but we did get a lower high and a lower low today. So imagine that. We actually gapped down below the low, got below last week's high point. So got briefly into last week's range. So again, it's hard to be too bearish when you just have barely touched the very tippy top of last week's range. The week's prior's range. So again, same idea that we talked about before. Never aggressively be bearish when you're at the top end of a wide 4-week range like we are right now. Now eventually we're going to be moving that up. In fact, we have to move that up now. Here, let's move that to this one, and we're going to keep this one here for a while. Here, let's go back to a 20-day. So right at that low point there. Somewhere in there. There we go. Let's put it right there. So there's the 4-week range, more than 10 points. That's a wide range from what we see. Never be aggressively bearish up here. Wait until you're at least in the lower half of the chart to start to add more bearishness. And then, of course, breaking below the low point of a tight 4-week range typically can be more bearish. So we are not anywhere close to either one of those. We have a strong... I mean, we even had a strong buy the dip rally today after that dip got down to below 273, and then just about, in fact, it closed 3 cents above yesterday's low point. So, and easily got back above last week's high point. So, bearish candle, not nearly as bearish as obviously could have been. We'll take a look at the range here. The volume picked up to 68 million. The range is 1.5 points. The high is at 274.42. That was just a smidgen below yesterday's close, so we almost filled in the gap there. So you might say 1 2/3 points was our range when you include the gap. If you take a look at that on this basis, there's your volume, 60 some odd million. still below the average, so bringing the line down, and the range was up. So that was a pretty decent range. We don't want those kind of ranges. We want 1 point ranges, 1 to 1.25 points. So we want this line to come down. If the number continues to be in this range and we get volume picking up again, that's going to be bearish. But as of right now, the trends for both of these are down. You can see too, volatility drop back down below 10. So we never did get up above this 10.5 level that we talked about as a resistance level for volatility in the short term. On an absolute basis, you can see we're back down to a bullish level, to a market who cares level, and you can see that on a relative basis, we also came back down. Let me refresh that, back below 80%. So again, back to an extreme low, which right now suggests we're back to bullish. Who cares about any kind of bearish news type of market right now? And so, those kind of markets grind higher and melt up. You hear that phrase a lot. Start to melt up higher and just continue to grind. Now we are 4+ months into this intermediate posture, so expect some near-term volatility and expect that volatility to start to move up in the 85 to 90% range. But as long as it stays in this area and doesn't significantly get above that, then the long-term bullish trend is still intact. Which is the expectation, actually, considering how high market sentiment is. Yeah, we'll probably get a little intermediate bearish pullback, get that intermediate line a little bit below 50, but nothing too major because of how high market sentiment is. We never go from strong bullish to strong bearish. We go from strong bullish to weak bearish, start to work around things for a while before things start to pick up. So at some point in time here, January, February, seasonality is going to kick in. We're going to get a weak bearish intermediate pullback sooner rather than later. We're not going to get a more major one probably until the spring, but even that will be short-lived as everything I've shown you suggests. 2018 should be maybe not as bullish as 2017, but a pretty decent year according to how bullish 2017 was. All right, now let's take a look at what's driving the price action. Again, a reminder to on Twitter to follow me on Twitter for more content I'm putting out there, to like and retweet, especially tonight's Market Outlook tweet. We got close to 100. I think we got to 96 on Monday night's video. Drop off last night. That's my fault, getting it out later. Hopefully this one gets out on time. We can try to shoot for that 100. The goal is to get 100 likes. So again, and the more you do it, the more Twitter will keep pushing you, all the different tweets I'm putting out throughout the day to make sure you're seeing those as well. All right, from a calendar perspective, the main thing that came out today was the import and export prices. On a month-over-month basis, you can see they were up a little bit here. The last month was revised higher on the import prices. Up a little bit, not up as much as expected, but still up, to that 3%, 2% range. So strong price growth, in prices. And again, the other major thing that's coming out, wholesale inventories were strong, 0.8% versus the 0.7, much higher than before. So strong inventory growth that impacts GDP estimates, keeps them up higher, a marginal jump back up to 2.8%, but still hovering right around that 3% range. And then we had the petroleum status report, and the petroleum inventories continue to drop off like a rock, and that's supporting the prices for crude oil. You can see crude oil continuing to trend higher. And pushing that upper Bollinger Band up. It's getting pretty, that's a pretty decent run. The Bollinger Band width is getting high. Just to kind of give you an idea of like what the Bollinger Band width for SPY looks like right now. There's been a few times where it's gotten to be about 5%. This is a percent number over here, and it's the width of the Bollinger Bands relative to the current price. So this one isn't absolute. This one is relative, whereas the MACD isn't an absolute number. It does take a look at the absolute number between that. This one is relative, and you can see for the S&P, 4% is about as high as the bandwidth gets before we start to, go sideways. We got a little bit above 4% here on that run when we pushed up above the moving the band right there. Of course, we got way up there in last February during that 4th month, that kind of last push higher before we started more of a decline. So, so yeah, the Bollinger Bandwidth is up above 4% right now, and 4 months into. So that kind of gives you an idea of how significant that is. And crude oil, lately, it's been right about 15%, and we're getting to that point now where it doesn't turn bearish. You can see all these other peaks. The trend stayed bullish, but at least pulls back down to that moving average for a target. So a good run. Crude oil's had a good run. Might be some pullback here, especially if it coincides with the broader market pullback. We take a look at and you can see it's, again, from a 2-week standpoint, USO is up 6.5%. Emerging markets, they've had a strong run. In fact, let's go a little further. Let's go to 2 weeks, or excuse me, a 4-week basis here. You can see 9.5% run for crude oil. Emerging markets themselves are up 9% over that time frame, a little less than 4 weeks. They've started to pull back a little bit, and so nothing earth-shattering, just pullbacks, right? You can't go up forever, as odd as that may seem. You can see the S&P 500 is up 3.5% during that time frame, but not anywhere close to what international stocks have been doing. And the IWM, it should be rallying, right? If we're this risk on, look at the dollars down at 1.5%. Long-term treasuries are down. High yield has been lagging behind. Usually high yield, you can see high yield and the S&P usually go up together, not by the same amounts, but they kind of move together. You can see high yield's been falling before the stocks have been, and again, IWM was outperforming. It kind of stopped the outperformance while the S&Ps continued higher. So again, it looks like there's some signs out there of that will get this near-term pullback. I've said that before, and we've continued higher. So, again, the expectation when you're at the end of an intermediate posture is more near-term volatility, more near-term highs, more near-term lows. This one that we've been on right now has been a record-setting near-term high that's coincided with the beginning of the year, new tax laws, new things going on that's pushed us up. Now, it's run out of buyers, right? They're not that it will create a bearish trend, but it's losing the momentum that it's had. Looking over that same 4-week time frame on the sector rotation, energy stocks have, not surprisingly, benefited from crude oil's rise, from the weakness in the dollar. Materials also outperforming, industrials up there. Those are your 3 sectors you would expect to outperform when the dollar's been weak. And you can see with long-term bonds dropping, look at utilities. A 4-week decline of more than 8%. Real estate's really been dropping here at the beginning of the year. Now down 4% over this 4-week time frame. Financials lagging the broad market, even with the jump higher in yields. And you can see the yield, long-term yields here. Let's look at this chart. The 10-year yields up to 2.55%. Got up earlier this week up to 2.6. Today got up close to 2.6%. That's where its 52-week high is. Now, last time we hit it, that again at the end of a 4-month intermediate run, we went from 2.6% all the way down to 2.2%. I don't necessarily think, I said, remember, a lot of that was fueled by sentiment that we get things done. Nothing really got passed here, and there was some roadblocks from a fiscal standpoint. And so that's why the market's like, okay, well, maybe we're not going to get everything that the market was expecting when the current administration won the election. Now, there obviously is something passed, and so while we may hit 2.6% and find some weakness, again, coinciding potentially with broad market weakness, probably won't be the same. Probably won't drop down to 2.2% again, because you already have a tax reform bill passed. And you have infrastructure bills pending, or at least in the works and speculating, and there's other things, but that's the next big fiscal accommodation policy that can really help boost the market. All right, so far our trade idea of the day, you might have snuck a peek at it here, is in that consumer discretionary area. If I were to go back to the sector rotation, just look at today only. Energy holding up well, industrials, financials had a little bit of a bounce, but they've been lagging, right? But look at the other sector that's been outperforming. is consumer discretionary, and retail had a decent day, especially JWN. Now JWN, you see here's a 52-week high. Now you notice over here on the left, on my left at least, that the 52-week high was higher. We dropped here, and you can see it when I look at this chart here. We dropped from 60 down to these levels. So as this has moved off, it's made this 47.5 level the 52-week high. You can see there's multiple instances where we got to 47.5. It couldn't break through, but we did at the end of the year. We came back down after the new year, retested that support level, and now have bounced off of it with strong bullish posture, rising market sentiment getting above 50, near-term line rising. You look at the two lines. Good volume today on this bounce, so strong volume. We take a look at the two-line versions. You can see the MACD and stochastics are below their moving averages, but above their midpoint, so opportunity for a bounce. Now that we've bounced off the 17-day moving average, back above the 8, bounce, continuing higher off support, and then finally looking at the Bollinger Bands. JWN, sorry. Bouncing off that 20-day moving average, a rising 20-day moving average. So there's opportunity here for a continued move higher and trend higher, but nothing too significant, right? Because while the posture is strongly bullish, it's mature, and we talked about we manage expectations. So I'm not going to aggressively buy the stock. And when I say aggressively buy the stock, I say aggressively because, number one, buying stock has the highest delta of any bullish strategy, including all the option strategies. And number two, a normal position size would be considered aggressive, right? So I'm going to pull back on the strategy with a smaller delta, and I'm going to pull back on my position size and go instead to look to sell, 37 days out, look to sell that put at that resistance that we've now, that is now support that we've now bounced off of. You can see I can get a decent credit here, probably about 60 cents, which is what you need on the $2.50 wide spread to get a 30% return on risk. Actually, you need 58 cents, so you're right around that target. So you might have to wiggle around here and see what you can get. You can see it gives you, if you get that 61 cents, it gives you a higher probability, a 65% chance of success. It puts that break point, the break evens here at 47, just under 47. Remember the new support is at 47.5, significant support. So you've got that break even point there, but that's the point we look at to say, okay, no matter what day it is, if we get to 46.30 or 46.25 in that area, I'm going to have a loss. If you look over to the left, in that gray box over there, about 55, 60 bucks. That's about what my gain is. So it gives me a 1-to-1 return to risk ratio. So I'm okay with it doing, I'm okay with it going down from where we're at, as long as it holds support. And even if it kind of messes around the support area and kind of, a little bit of a fake out, maybe intraday moves getting down below, but then gets back above, as long as it doesn't get down too far, which gives us a good point there to say, okay, if we get to that point, yeah, now we're down, over $1 below that support level. I'm at a loss that I can keep my reward risk ratio pretty decent, and I've got a low probability, it's not too low. It's got a high probability of touching it, getting down there. But staying down there, that's another story. So if we close down below 46.25, I'll take a small loss. I'm going to move on to something else, knowing that the odds of it staying up above this support is higher because of the technical picture. Now, those odds on the analyzed, this doesn't take into account anything about what the chart looks like. It just looks at volatility levels and price moves in this shaded area of where the price can move. So it has no idea what this looks like. So we do, and so we can say, okay, well, there's probably a little bit higher probability, not 100%, but enough of one to be able to make this bullish trade in a strong bullish market in a sector that held well today, while the market itself pulled back just a little bit. So in summary, the markets are, didn't quite get that record today, but still strongly bullish. Plenty of evidence for the potential of a near-term pullback. A near-term pullback would not be that big of a deal. So whether we get it or not, the posture is still strongly bullish. And we have some trades that we've done that recently as examples of how you can add some bearishness to a active trading portfolio without going overboard. We've also done plenty of bullish trades here recently in the direction of the trend, like today. We just have to manage those return expectations, how aggressive we are, because we're not in the same type of bullish market that we were 4 months ago. We're not in the same type of bullish market that we were coming off of the low in August. So it's a different situation, and so our return expectations and risk management should be different too. As always, remember to subscribe, like, and comment on the video down below here. Also, remember to follow me on Twitter to get more content throughout the day, and then make sure Twitter keeps pushing you that content. Engage, like, and retweet, comment, share on Facebook as well in the Market Outlook community. So, again, thank you very much for watching tonight. Have a great evening, everybody. We'll see you all tomorrow.